I don't think that, I don't know if you remember 2000 very well. You do.
Were you 8?
I mean,
No, I was in fifth grade, but my family has long involvement in New York State politics. My mom was a vice campaign chair for
My
one of the
mother,
Cuomo
my mother
campaigns
was
in the
also
80s.
involved in politics. My mom was the lady who would make sure that your name matched your voter registration card when you walked into the VFW.
Important
that's
job.
good,
Gotta
but
make
she
sure
didn't do any
people
due
are voting
diligence on the man, and she married. So
That's a low blow.
it's a little low. But I'm just saying, like it's funny how she checks off people at the voter registration, but she didn't look like, maybe I should do a background check on this guy. Random strangers, we got that.
Why is he off all day wearing a suit and driving a caddy?
Right, exactly.
Is he in politics too? I'm sorry, I cut you off, Chris, and then Tom made fun of my heritage. Go right ahead. I'm sorry.
I mean, I could see you actually as one of those crazy kids that starts watching the market when they're 8 years old. But
I did.
There were some very interesting election cycles. I mean, I started out in this business in the 1980 election cycle, which is really going back when Reagan won, and been going through kind of, I feel like every cycle for the last, we're going on 45 years and 44 years. And so I feel like this is just always one of those crazy quarters where I don't want to say all hell breaks loose, because there's been so much stuff like in 2000 and in 2008. I feel like the election was overshadowed by everything else that was going on by such a, I kind of don't even remember the election, especially in 2008. I don't really remember the election at all. I just remember everything after the election, which was the aftermath of the economic meltdown. And in 2000, it was kind of the same thing. So I think there's all these cycles that we go back to that brought in some real volatility during this Q4 period election year. Even in 2016, which was a crappy year for volatility, post the election when Trump won the election, especially immediately thereafter, it was a pretty wild November, December. It ultimately unwound itself in 2017 to be one of the worst years of trading ever, because the volatility was nil, which I never thought would happen. Especially first year Trump presidency, I didn't think you'd have zero volatility, and we literally had zero volatility that year. I don't think we had a 1% move until 2018.
Who would have thunk?
Yeah, who would have thunk? And then in 2020, it kind of felt like almost the exact opposite. So anyway, I wanted to bring that up as a topic for today, because if you look at the forward curve in volatility, you can see that the expectation, a few months ago, the expectation was that volatility would come down significantly. But now the expectation is that volatility will come down but kind of go sideways. And I'm just curious, what's your take on what we're, of Q4 2024, because what is today though? What day is today?
Today's the 24th of September.
24th. So we're 7 days away, 6 days away. So give me your Q4 2024 takedown.
So there's a few things to unpack here, right? You mentioned this idea that in the fourth quarter, we tend to see something perhaps around presidential election years that jolts the market or reshapes the race. And since 1980, there probably have been 4 big October surprises. I don't know if we want to count the global financial crisis as another one, but perhaps that's number 5. Of course, in 2008, you had the Republican Congress, Hank Paulson on the floor of Congress pleading to pass TARP. And ultimately, it was a hugely important piece of legislation. It may have cost the Republicans the election. I don't think anyone was going to beat Obama that year, given everything that was going on in the country at the time. Regardless, though, in 2000, it's not just the market crash, right? We find out that George W. Bush apparently had a drunk driving arrest in 1976, just days before the election. In 2016, we get Hillary's emails. 1980, as you mentioned, Tom, the Iranian government apparently negotiating behind the scenes with the Reagan campaign to make sure that those hostages aren't released while Carter's still president. And what happens the day after Carter leaves office and Reagan's inaugurated? Iran releases all the hostages. So October surprises are possible. They're feasible. The thing is, it's not really so much October traders should be concerned about when we think about elections post-presidential, regardless of who wins on November 5th this year. It's really just the sweep of history that the markets tend to like the clarity that once the elections come to pass, that provides. There's a study that I saw earlier this week from Bank of America Global Research where it segregates the results of presidential election years by the first 10 days of the month and the last 10 days of the month. When you get through November, the first 10 days of November average a return of 1.06%. The last 10 days average 0.02% higher. For December, it's 0.48% higher. And then the last 10 for December is 0.95% higher. What's remarkable is that the average 10-day period over the course of any week, any presidential cycle, typically sees a gain 55.5% of the time. These weeks going into the end of the year during presidential election cycles typically see gains to the tune of like 66% of the time. So history tells us that once we get through the election, you're talking about a market that, going back to 1928, typically likes to rally into the end of the year. So right now, with the technicals shaping up the way that they are, if there is any vol that arrives in the short term, particularly because we have a Federal Reserve and now a People's Bank of China that are flooding the zone with liquidity again, it feels like reflation's here. And that's what happened in 2016. You get a Republican Congress unified behind a Republican president. The liquidity spigot's already open with the Fed. You're now going to get all this government spending. That's inflationary. Asset prices go up. And so you see Treasury yields go up, but stock prices go up, the dollar goes up, copper, oil, gold, base metals, everything rises in value. And we're kind of in the throes of that right now. So who's to say that the presidential election is going to disrupt anything? If the two modal outcomes are either gridlock, which is what we're doing, and markets are fine with that, or the other likely outcome is you have another Republican trifecta, and then you get all the spending, you get tariffs, but you're going to get all the spending, you're going to get lower taxes, you're going to get a push to the Federal Reserve to be looser with monetary policy. And that seems like the market may enjoy that in the short term as a sugar rush. So end of the year, I feel pretty good about stocks. And I know you don't like year-end targets, but the macro environment stipulates long deltas are still appropriate. So I'll just say that's where I'm leaning.
I'm not so sure I agree with that. I think the likelihood of gridlock is probably, that's what we call gridlock, is probably
it's number one.
Yeah, I mean, it's probably 90 something plus. One way or the other, I don't see anything but gridlock. Regardless of who wins, I don't see anything but gridlock. I think the market will like that. I think the market will be less enthralled if there's any kind of political dominance either way. I don't think that's good for. I think gridlock's way better for us because it takes a lot of the extremism out of politics, out of the political hands. And it moves us much more into the center, which I think most people like. As far as the market,
put a note in here. I'm looking at Polymarket right now. They actually have a new, I love this market. It's the balance of power market on Polymarket. So you can bet on different outcomes like Republican sweep, Democrat sweep, and then all the mismatch variations. The top betting option right now, 29% chance, is Republican sweep. The second highest favorite option at 28% is a Democratic president, Republican Senate, and Democratic House. The third then is Democratic sweep at 21%. So having we're talking about a 50% shot right now as priced by betting markets that you're going to see one party dominate. Every other is gridlock. And that to me is problematic, right? The market actually likes gridlock the best because we could say with certainty, nothing significant will change. And so what we've been penciling in terms of tax rates and budgets, and that all stays the same. We don't need to make any new assumptions, but a Republican sweep or a Democratic sweep, those are definitely the more tail risks. And the market's saying that those tails are fairly fat. I mean, 50% chance.
Yeah, I think that I think it's a little lower than that. I think on Polymarkets, they everything's skewed because of crypto. And so they lean where whoever's, they feel is a bigger supporter of crypto. But I watch Polymarkets.
I feel that way too.
What?
Yeah, I feel that way too. I feel that way about Polymarket too.
Yeah, I've been watching
the spreads between the markets.
I've been watching Polymarkets for probably the last, 3-4 years. And it's definitely skewed to crypto. If you go to predict it, the lines are way different. You can't arb them though, so it doesn't matter. There's no arbing, so it doesn't matter. But I like watching them both. I think it's interesting. I hope they get the election markets through the CFTC approval prior to the elections. But I got a feeling that the regulators are going to try to torture everybody and stomp this out and not allow it to happen in the U.S. Regardless, since at Tasty we like to play the statistics, the reality is when you look at the distribution curve of the 2024 election, 70% of it falls, pretty much 70% is going to fall inside that middle of the distribution curve, which means we're going to essentially be gridlocked. And given scenario, which is how we play the markets. We don't play for the tail. We don't play for the tail on each side. We don't play for the outliers. We clearly play for somewhere in the middle. Given that, I think there's a couple of interesting scenarios here. First one, which is there is the likelihood to me that I feel like this whole market is in a buy the rumor, sell the news type of mode, as witnessed by what just happened in the bonds after the Fed number, after the Fed reduction in rates, which has been.
That's always how the market is.
I don't know if it's always how it is, but I think this time, watching how the market, and this surprised me actually, how the market bid up the bonds prior to the Fed reducing rates. They got everything they wanted. Now bonds have dropped 3 points. I kind of feel like the stock market is going to replay that movie in a very uninteresting way. I feel like we're going to get a pretty decent, I don't know, pullback around, between the beginning of October and the end of November, just because I think this market, this last rally to back up to record highs, I think we are buying into all the hype that you just talked about. I think that's what we're seeing right now.
There may be reasons to buy into the hype, though, particularly if you're a longer-term trader. It's not really for...
Yeah, if you're a longer-term trader, there's always reasons to buy every dip there is, ever.
Yeah, of course. But let me throw this one out here, which is there's two things that really stuck out to me with last week's moves. We were talking about this on last call on Friday, Tony, where we were decomposing the different types of cuts the Fed has done. When the Fed is cutting for maintenance reasons, historically speaking, 3 months later, the S&P 500 is higher by 4%. And when I say maintenance, I mean, are we in a recession that quarter? If the answer is no, then we're not cutting for a recession reason. COVID, long-term capital management rate cuts, that's a different story. Those are emergency. But even in panic type of situations, those emergencies, 3 months later, because it's not economic related and the zone is flooded with liquidity, S&P is higher by 6.8%. So we're not in an emergency. We're not in a recession. I think this is a maintenance cut. And then the other one from Carson Research, really interesting. Whenever the S&P's been within 2% of all-time highs in the Fed's cut rates, the market's higher a year out 100% of the time.
Do you know what's so funny?
This is the 21st time they've done so.
Do you know what's funny about those?
Dice on being a ball.
What's funny about those statistics is that that's what I hear you say, but then I have a million other people that send me the other side, which says the market is sharply lower, like X. Like this is such a curve-fitting exercise because people send me stuff that says market is lower, 1 year from now, whatever it is, or everybody can find a stat out there that shows whatever they want to believe. And I, somebody with
that's why it's actually the way that you segregate this data, right? If you were to look at how the market performs and you were to tally it after every single time the Fed cuts, you're going to get a different outcome than if you only look at the data from the start of the cutting cycle. And so I wouldn't call it data mining, but you can massage the data. And this is what makes a market. Like all of us can massage the data to more or less confirm the biases we have. So I think it's important, instead of getting the whole series of data in front of you and saying, what do I want to look for? Just ask a question and see what the data tells you. And so when the question is posed, what happens when the Fed cuts, when the stocks are within 2% of all-time highs? The answer is higher 100% of the time a year later. I feel pretty comfortable with that.
You're comfortable with 100?
Comfortable with 100% hit rate, yes.
Yeah, I'm thinking out.
So you're saying there's a chance.
So I'm thinking out 45 days. And I'm thinking out, 45, 60 days from where we are right now. And the way my mind works is, like I don't have December positions on. I have November positions right now. And I mean, we'll put December positions on soon. But my mind only thinks that far out. And I'm thinking that we are right now in a very interesting situation where I think the risk reward and I think the amount of, given where we currently are, the election, everything that's going to play out over the next 45 to 65 days has to be freaking perfect to hold these prices. So if for no other reason that I'm just betting against perfection, like it has nothing to do with who I want to win or what I think is going to happen or how I think the market's going to react, because I don't think anybody knows. I think if we told you today, just like with the Fed thing, if I told you what the Fed's going to do, you wouldn't know what to do. If I told you who's going to win the election today and by what amount, you would have no idea how to play the stock market. Nobody would. So,
well, I would turn around and take that information and sell it to people like Ilya, right? So I would know what to do with it.
I don't know what I would do with it because you already got Ilya.
I think somebody how I would treat it. I don't know what I would do.
You have Ilya and Dylan. I'm sorry. I only have Tony. So because I don't know what to do and because I never think that perfection is a reasonable bet, I would take the other side of that, which says I think that there's a much better chance and a much higher likelihood that we are going to see an opportunity with pot odds to the downside here as opposed to the upside. So We just saw a
Yeah,
nice little
and the
sell-off
contours-
while we've been talking with Chris.
Chris caused this. Even the S&P down 12. That is correct. Trading near their lows now.
But the NASDAQ is really the interesting thing. It was up pretty big, and now it's down
Down
70.
73. You are correct. Trading near its lows.
Yeah, and none of this, by the way, zero part of this surprises me. Zero.
Rally's back. It's going to surprise you.
Tom, can I make 2 quick points as we go out here?
Yes, please.
About the election results, I think that's really important, right? If I just said today Harris is going to win 270 to 268, does that mean the election is decided on November 5th? Does that mean that there's lawsuits that drag this out until the end of December? Does that mean it's kind of like a rerun of January 2021? We don't know. So this is not necessarily going to be decided on November 5th. So this particular election, there's a long tail for the results and the election itself to weigh on markets.
I understand where you're coming from, but I do not think that will be the case this time around. I think America is tired and fed up with the idea of not wanting to repeat 2020. And I think the election integrity is important to people. I think that this is not going to be 2020 again. The winner will be decided on election, and that's it. I do not think this thing will linger on. I don't think that that's the risk this time. I legitimately thought that was the huge risk in 2020, and it was a huge risk in 2020. In 2024, I do not think that's the risk at all. Election integrity is more important than either of these two candidates. And our whole political system and the future of democracy depends on election integrity. And so I am not worried about it this time. This will be a smooth transition of power if it is such. I mean, it has to be somebody new, so it will be. And either way, this will be decided on election day. I don't think that goes beyond that. I don't think anybody in this country wants to deal with the crap from 2020 ever again.
The other point is, as we close out the door, I would remind people that last week after the Fed's rate cut, there were a lot of economists, Republican-leaning economists, saying this is it, this is the end, here comes another Kamala crash. In 2016, if you listen to Democratic economists like Paul Krugman, who were saying that if Trump wins, the market's going to crash, it's the end of the world, probably didn't do that well trading that year, because if you got short stocks on the Trump win, it was a very painful ride. The point is that during this election season, don't listen to economists, particularly those that are politically affiliated. Don't put any politicians on pedestals. Those gods will always be torn down and killed. Focus on the volatility and the markets here. It's nice to have opinions. We can talk about what policies may impact certain sectors moving forward, but don't listen to anyone that's in the news promoting a candidate for trading ideas about how you should position yourself.
Yes, but
it was just so silly last week.
Do watch the election unspecial on Tasty on the night.
That you should do.
Yes, you must watch the election unspecial.